All right, here we are again. Let me open up my screen and then we can get rolling here. Hello, Alex and Brandon. So, um, here we go. Yes. So anyways, maybe we'll just wait a minute or two for other people to show up. But what we're going to do now is now that we've had our basic introduction to derivatives in general, we're going to spend the next 2 weeks going into more detail in looking at futures, forwards, swaps, and options. And then much of the rest of the course will be based on options themselves, their properties, pricing models, which will take quite a bit of time, but also risk management considerations. In other words, exactly what are we doing with options? Why do we use them? How do we use them to hedge risk? That's going to take up quite a bit of time because it's a fairly complicated topic, but luckily Excel will be quite sufficient for us to accomplish all of these objectives. If you wanted to move up to the next level, you would start to need a more, let's say, a scientific programming language, but Excel is excellent for what we need to do. And so I basically use it for all my courses because it's so powerful. And in fact, if you need more power, it turns out Excel actually has its own programming language built into it called VBA. And recently, although I haven't had a chance to do any research about this, Excel seems to have found a way to connect itself with Python. You'll see if you look through all the ribbons, there's some references to it. I didn't even notice this until fairly recently, and I still haven't had a chance to see how that works, but it does now have some rudimentary, at least Python capabilities. So, they're trying obviously very hard to keep it up to date. And also, they've got some kind of AI capabilities. This Copilot thing apparently is an AI package of some kind. So, Excel is really pushing hard to keep up with the technology. So, but we're not going to touch any of those here. We're just going to use basic Excel to get the results that we need. And so, by the way, did anyone have a problem finding the video from last week, or were you looking for it and you couldn't find it? I think one person said they were looking for it around. It should be in Brightspace. Let's see. If you go back to your Brightspace account, you'll see that. One second. It would be in the See, now this is something that really drives me crazy. I have this really powerful antivirus program, but sometimes it drives me crazy because as long as it's on, I've got this thing on called VPN, which is virtual protected network or something like that. There's some websites that I just can't look at without turning off the VPN. So let me take care of that real fast. All right, here we go. So I can go back to home NYU now. And just show you where you can find your recording if you want to look at it. I mean, of course, if you were here, you may not want to bother, but it's there if you need it.
I had emailed to ask because I couldn't find it in the YouTube. But
Did you get the link I sent you this
I
afternoon?
did. I saw the link, but I saw the link when I had already seen that you posted in Brightspace.
Oh, okay. Yeah. So it's up to
Yeah,
you.
that's helpful.
Okay, good. But I'll also show you how to find it in YouTube. If
Okay.
let's say for some bizarre reason Brightspace is having issues or they're updating it or something. You never know what's going to happen with technology. I'm a very big skeptic of technology, but I know we have to use it.
Do you use the NYU VPN?
Which one?
Do you ever use the NYU VPN?
You know what? Once in a while, I'm required to use it because when it comes time to sign a contract, I only can get at it through the VPN.
Okay.
And I find that the VPN is kind of a headache, but with enough time on the phone with technical support, eventually I can get it to work. It doesn't normally work unless I call up technical support, but eventually I get it done. So, anyway, if you go to Brightspace, what I would do is I'll put it in the same, if you go to Brightspace, you'll see that, let's see, if you go back to your Brightspace account, you'll see that folder with that week's notes. So you can see last week was week 1, and you'll see it down at the bottom. And the title, it has the date on that we met. And so there it is. So there, all right. Now, as far as the YouTube goes, the missing link, I think, was that you have to know what I guess what username I'm using. Oh, did you raise your hand? Yes, you did. I see that. Go ahead.
I was gonna wait until you were done, but it's having to do with last week's lesson as well. The one that
Oh,
you
okay.
posted in Brightspace didn't have the notes. I didn't see the notes on it.
Oh, really? Oh, did
Yeah.
I really forget to do that? Hold on a second. If I did, I'll take care of it right now. No, these are the notes right here.
Yeah, I
Session
didn't
line.
see any notes on them.
Oh, wait a minute. You know what? Uh, here's one of the most annoying things that I've ever encountered in my life. All that writing that I did, I think, oh God, you know what? The problem is that when you turn that into PDF, it does not seem to pick up the on the handwritten notes. So I'm glad you mentioned that, because I must have accidentally could have sworn I used the right one. All right, I'll tell you what, let me just delete this and I'll put in the one that works. Let me go back here real fast. So yeah, so when I'm writing on these slides with my tablet, I don't know how or why this happens, but if I try to turn it into a PDF file, it just doesn't seem to work. It just can't see the writing. God only knows why. I mean, what the hell, you know? But let me get this thing open. Hold on. All right, I'll get it right now. Now, also, I've had trouble with Excel files too in the past, and this is with respect to Brightspace. What I would do is I would put an Excel spreadsheet in there, and then when people open it up, it had somehow been converted into a PDF file, and I kept getting on the phone with them. They kept telling me that it wasn't happening, you know, and I could see for myself that it was. And what good is it to have Excel files if it turns it into PDF? I mean, really?
There's so with Brightspace, from last term that I was in, another instructor had a similar issue, and I think there was a workaround
Oh,
with the way you downloaded it. Let
yeah,
me I'm gonna play with it and I'm gonna see if I can figure it out.
all right.
Uh,
But no, but I want to make sure that this is working correctly.
right.
So you can see my technology is horribly slow tonight for some reason. But all right, well, anyway, so I'll tell you, let me make a note to myself. I'll just fix this later. Clearly, there's something going on here that doesn't want to work. So I'll just go in there and try to repost the handwritten notes from last week. And if worse comes to worse, I'll just email it to everyone. I mean, that definitely works. Um, okay. And so, yes, as I was starting to say, as far as the YouTube goes, what I've done is I've organized it into playlists, which I don't know if you're familiar with how YouTube works. I think this is the part you need to find my stuff. It's they assign you a username, and you can see there it's Doctors ACA. So if you go into YouTube and search on Dr. ACA, it should bring up my channel. Now it's already there, so I'm not sure if this is going to work, but it's going to say, "What are you talking about? You're already here." So then now there's a lot of files here because I've recorded a lot of sessions over the years. But in order to make sure you can find it under playlists, there's one for us called Derivatives Spring 2025. So if you click that on, you can either watch it or just look at the list of titles. Okay, so here it says view full playlist. So you can watch it from here or you can watch it from Brightspace. Okay. The thing that in the past was a real problem was it used to be these files are very large. It used to be that Brightspace didn't have enough storage for videos, but now I think they've taken care of that problem. But anyway, so in the meantime, why don't we get back to where we left off? So session 2, again, we're going to have a more intense look at forwards and futures. Now, these are the two most straightforward types of derivatives. And they've been around for quite a long time. I mean, they're not really all that complicated. It's just that there's a lot of institutional details we need to know, and we want to understand what are they used for. But there is some math going on here too, which we'll see when we get to that point. So we'll start by reminding ourselves that this week we're going to review the basic properties of forwards and futures. We're going to see how to determine the forward price of an asset. We're going to understand the marking to market process for futures contracts, and then we're going to find out, this is more of a theoretical question, why spot and futures prices will match each other on the last day of a futures contract. And there's more. Is there a relationship between forward and futures prices? You might think that because they both are a similar type of derivative, that they have to equal each other, but that is not necessarily the case. There are important differences between them. And then we're going to gain some insights into how to hedge risk with futures contracts. All right, so as we saw last week, a forward contract is simply an agreement between two counterparties, which we agree to either buy or sell an asset at a specific date in the future, but the price is determined today. And that's the so-called forward price that I alluded to earlier. And that's where the math starts to get a little bit more complicated because the forward price doesn't just fall out of the sky. There's a very rigid mathematical relationship between what we call the forward price of an asset and the spot price. So the spot price, if you remember from last time, is the cost or price for buying an asset for immediate delivery. The forward price simply means the price for future delivery. All right, now it used to be you could look these up in the Wall Street Journal. Lately, they've stopped doing that. I don't know why, but let me just show you a quick example of this. Just say you're interested or you are doing business overseas, all right? Now, if you're doing business in any other foreign country that uses another currency, you're going to be exposed to foreign exchange risk, all right? There's no getting around that. What you have to do is find ways to manage it. You can't avoid it. I mean, maybe there's to a certain degree you can. We have an advantage living in the US because the dollar is considered to be the world's vehicle currency, as it's called, meaning that a lot of international transactions are priced in dollars. But realistically, if you're going to be doing business in a foreign country, you've got to be prepared to receive or sell foreign exchange. And then you've got to take on the risk of fluctuations in the value of that currency. So suppose that the spot price of the pound is, let's say, $1.25 per pound. An importer needs to buy pounds, but not for 3 months. Now, here's the problem with that. If, let's say, my company periodically buys pounds for investing in my business in London, and the thing is, I don't know what the pound is going to be worth in 3 months. So if he waits 3 months to buy the pound, the risk that he faces is that price will rise. And that's just another way of saying the dollar will depreciate. Now, of course, there's always a chance that it could go the other way. The price could go down if the dollar gets stronger, but the importer doesn't want to have to deal with foreign exchange risk. So what he can do is can enter into a forward contract to buy British pounds and it's called the 3-month forward exchange rate. 3 months because that's when he needs the pounds. He's agreeing to buy them and take delivery in 3 months. At that time, he'll pay the forward price for the pounds. Let's say that is currently the forward exchange rate, the 3-month forward exchange rate is, let's say, $1.27 per pound. Okay, so that means the contract enables the importer to lock in a price of $1.27 per pound when buys the pounds in 3 months. Okay, so in other words, the spot and the forward price are usually not the same number. Now, it did go up a little. I mean, he's paying a 2 extra cent premium, but the thing is, he's locking that in. It's a done deal. In 3 months, he has an ironclad contract. Oh, yes, go ahead.
Is there a formula that I may have missed in the last class, the last week's course, last week's session, that would have helped with number 1 on the assignment? Because I may
Oh,
have
let
missed
me go
it.
look. Oh, all right.
I
Let
was-
me open that up. I hope you had everything you needed. Let me check and see if there is a
It
problem
may have
there.
been me who missed it because I had a lot going on around me that day. So
Okay.
that
I'll
possibility.
just, yeah, I just want to go double check real fast what you were asked to do. Oh, wow. I guess maybe not. Oh, that's very embarrassing. I guess I thought I had included that, but maybe not. Let's go get those notes open from last week and see if there's any mention of it. If not, well, then I guess I'll have to give you another week for that assignment. Um,
Uh, I found a formula online and it seemed pretty consistent with different platforms, but I just wanted to make
yeah,
sure I use your formula that
the
you
problem though is that you don't, yeah, I guess not. Oh boy. Let me look at it one more time of that question.
Yeah, there was no
Yes.
mention of section 1 here. There was no formula in the PowerPoint, but the rest
Okay.
of the question set could have been found in the presentation.
Okay, so we're definitely going to cover that tonight. So I'll tell you what, why don't you take another week? If you've already sent it to me, you can try it again. I'm glad you pointed this out so I can fix this for the next time. Boy, that did make it difficult, didn't it? There's no formula. It's not there. You're not imagining things. Wow. So, all right. So yeah, you can feel free to go ahead and just hang on to that until you can hand it in with assignment number 2 next week because we just haven't done it yet. You're absolutely right. Now the formula is not that difficult, but of course we have to go through it. The others, you're right. We should have been able to do those, but all right. So sorry, pal.
What is the cadence on the assignments as far as feedback? Do you grade
Oh,
them or how's that work?
yeah, I will do that.
Okay.
And although it might not be every single week, but I'll send them back to you with the correct answer so you can see what happened. And we'll do that, yes. But yeah, so I guess this time around you'll have to you'll have extra time just because you're right, there it wasn't there. Um but anyway, we'll see it tonight. The mystery will be resolved tonight. But anyway, oh well, what do you know? Speak of the devil, now forward contracts in principle, because they're contracts, you can write these on any asset you could possibly imagine. So because it's a private agreement, if I need gold in the future, if I need currencies, if I need bonds, you name it, somewhere out there is willing to sell me that through a contract. So we get together, but the forward prices are actually going to be the result of a very important equation. And so we're going to start by looking at the case where we have an asset underlying our forward contract where there's no income being paid to the owner. Okay, in other words, imagine that this contract is written on, let's say, gold. And if you own gold bars, I mean, you don't get any dividends or cash flows or anything. So here's what you have to do. This is the official formula. And so what happens here is that the zero subscript means the time, which means today. In these models, a time of zero means it right now. Okay. So the current forward price of this asset is calculated in the following way. So S is the spot price. So let me just make a few notes here. S is the spot price. Now, what else do we see here? Now, E is a constant, which you would have encountered. I'm gonna say if you probably had this, ran across this in math in high school, or if you've had math in college or whatever. It's a constant. Now, in order to solve for this, any calculator that you have should have a button that lets you solve for this. Now, here's something I do want to mention, just in case if you don't happen to have a really nice calculator like the Texas Instruments TI-84, for example, you may not be aware of it, but on your iPhone, if you go in this iPhone, I think you'll be shocked to see what it's capable of doing. So here's mine. I don't know if you can actually see it or not, but if you go to there's a little tiny icon in here. Oh boy. That's not going to be easy to see, is it? Oh, wait a minute. I had it. You see that little calculator icon down there? If you click that on, now they've recently changed this thing. It has two calculators built into one. It has a very basic one, and it has a very powerful scientific calculator built into it. Now, it used to be that when you turn it on, it would automatically go to the basic calculator, and you would have to turn it into landscape mode to call up the scientific version. But now there's a menu on here in the upper left-hand corner. God, this is so awkward. I'm going the wrong direction always. And it asks you, which one do you want? Oh, wait a minute. What happened? Oh, that's strange. You don't know. No, that's not where it is. It's that little button next to the zero. It's a little tiny calculator button. If you click on that, it'll offer you the either basic or scientific calculator. And so, of course, for our purposes, you want the scientific calculator. And you'll see an amazingly powerful, considering that it's free, full-blown scientific calculator right on your phone. So you'll never be able to say that you don't have a calculator with you. All right. So is it looking now I know that the other phones have them, but they're not exactly the same. So for this formula, I'm going to show you how to do this on the iPhone, because you may not have a TI-84 or one of the others. So we'll get to that in a second. And then R is the rate of interest. Now, that rate of interest isn't just any old rate of interest. We're going to see as we go along in this course that interest rates in these models almost invariably refer to the so-called risk-free rate, which means the yield on a treasury bill of the same maturity as the forward contract. So if this is a 3-month forward contract, we need the 3-month treasury bill yield for this formula. Now, of course, if you're not familiar with the treasury market, I'm going to show you a website where we can look up these numbers every day. So let me just quickly here it is. So you see how it says hometreasury.gov. So here's what you're going to find there. You're going to go here and under the daily treasury par yield curve rates, you'll see that across the top are the maturities of all the different treasury securities that we can buy. And you can see they range from 1 month up to 30 years. The ones that last up to 1 year are called treasury bills. The ones that range from 2 to 10 are called treasury notes. And the 28 years and up are called treasury bonds. But they're often all referred to simply as treasury securities or just treasuries. Now, the reason why they're called risk-free is because the government guarantees that you'll receive the money that you've been promised. Now, let's say if you buy a bond issued by a corporation, there's always a chance that they could go bankrupt. It's not likely in many cases, but it's possible. So the government is in a unique position because if they run out of money, they can just increase taxes or something. So the yields on these treasury securities are defined as risk-free rates of interest. If I buy one of these, like here, the 1-year treasury bill, I'm guaranteed to get a 4.20% rate of return. So we'll plug this into our model. And by the way, we're going to find out why that's the case later on. But anyway, and then T finally is the maturity of this contract. So let's say, let me jump ahead a little bit here. Okay, here we go. So we have gold. Let's say gold is currently selling for $1,500 an ounce. And we're interested in entering into a 6-month forward contract to buy gold. At the moment, the 6-month treasury bill yield is 6%. What is the forward price of this contract? So how would you do this on your calculator? So first of all, you're solving for this. Now, T, by the way, is measured in years, so that means 6 months is the same thing as half a year, okay? So 6 months means half a year, okay? So you're solving for 1,500 times e to the 0.03 power. So how would you handle that on this wonderful calculator? Let me go ahead to the next slide for this. So the e to the x button is, if you look, it's in there. There's a lot of functions in there. The button you need is labeled e to the x. And hold on. I guess I could move this to the next page. So you'll type 1,500 times open parentheses e Now, every calculator is a little bit different. Oh, okay. Sorry. I just realized I'm used to the chai, more used to the chai 84. So I have goofed. Let me show you what you have to do instead. For this calculator, for some reason, you have to type the 0.03 first. All right, I'm going to start all over again here. 1500 times open parentheses, 0.03 e to the x. And then you'll close the parentheses and hit equals. And you should get 1545.68. All right, did that work? So in other words, what it's saying here is that the spot price is $1,500 an ounce. To take delivery in 6 months, the price will go up to 1545.68. Now, the way to think about that is that this is the cost of financing your position. So what if instead of entering into this contract, I was in a position to borrow money at the risk-free rate of interest? Then I would have borrowed $1,500 for 6 months at 3%. And in 6 months, I would have repaid to the bank $1,545.68. So that's why this number is what it is. It represents the cost of financing this position in the spot market. Okay. Now, of course, you and I are not necessarily in a position to borrow at the risk-free rate of interest. So this is a very convenient transaction for us. So now the question becomes, why are we using the risk-free rate of interest? Now that has to wait a bit. All right, we'll get to that. Okay. But the interesting thing here is that if, let's say you go to a bank of some kind and they give you a quote, which is different than this number, we're going to see later on that you could actually earn risk-free profits from the mistake of the other counterparty of this contract. But that will have to wait. For now, we just want to know how to figure out the forward price of an asset given the spot price, interest rates, and time. All right. So that means if they still printed this in the Wall Street Journal, it would show you that gold prices are spot 1,500 and 6-month forward 1545.68.
But isn't this 3 months?
No, this one should be no. Oh no, you know what it is? It's 6% but for 3 months, half a year. So it's 6 months.
Right.
Yeah, that's where the 0.03 comes from. It's 6%, but for only half a year. So that exponent becomes 3%.
Right.
Okay. So that is how you would determine the cost of delivering gold through a contract in 6 months. So you would sign the contract and you would agree that in 6 months you will pay 1545.68 for every ounce of gold that you want to buy. Okay, so now that though only applies when the underlying asset provides no income to the owner. If you're buying or entering into a forward contract, let's say on a stock that provides a dividend, the issue there is that when you're in the contract like that, you're not actually collecting the dividend. Okay. So that actually puts you at a disadvantage compared to simply buying the stock. So that has to be taken into account in the price that we pay for this asset for future delivery. So that's why we have to make a distinction between these different cases. What kind of cash flows are resulting from this asset, if any? So, by the way, there's a brief review in here of how to calculate the future value of a sum in case you want to review that. By the way, when you use this rate of interest, that E indicates that this interest rate, sneak this in here. By using E in the formula, this indicates that the interest rate itself is being compounded on what's called a continuous basis. So you probably are aware that if you go to the bank and put money in the bank, let's say they quote you an interest rate of 4% on your savings accounts. They don't wait to the end of the year to pay you a 4% interest rate on your deposits. What happens instead in practice, with the banks at least, is that they compound interest on a daily basis, which means they're actually paying you the daily equivalent of 4% every day throughout the year. So what you're seeing here is the theoretical limit to how much interest can be paid for a given interest rate and time. Okay, it's a special case. It's the limiting case of how frequently interest can be compounded. Now, you might think that this doesn't happen in the real world. Why are we using it? Well, it turns out there are many mathematical advantages to using continuously compounded interest rates. So if we need something else, we can always do the conversion at the end. So the book that we're leaning on for this course, the John Hull book, he loves continuously compounded rates of interest. So his formulas almost invariably use continuous compounding. So, it's something we want to get used to because it's just more convenient. There's a lot of very good reasons why it's better to use continuously compounded rates than, let's say, daily compounding or quarterly compounding or whatever the case may be. So the E is a hint to you that we're using continuously compounded rates. So anyway, what if we have, oh, here's just another example. All right, great. This is a 3-month forward contract on a stock that does not pay any dividends. Now, you probably know that many stocks in this day and age don't pay dividends. It used to be a common thing for people would buy stocks. One of the main reasons to own stocks was to get these dividends at every quarter. It's not such a big important thing anymore. Many companies don't bother with them. The ones who do, the dividends are very, very small. There are a handful of companies that do provide pretty significant dividends. Coca-Cola is one of these cases. Believe it or not, now Coca-Cola came about in the 19th century. They've not missed a single dividend payment in their entire history, which goes back over 125 years. So, but that's a rare case. Okay. So let's say we have a stock that doesn't pay any dividends. The price is $90 a share, and I want to buy this stock through a 3-month forward contract. What price would I expect to pay for it when it's delivered in 3 months? Okay. So it's the same formula. 0.05 is the treasury bill yield for 3 months, and 3 months would be treated as a quarter of a year. And so what you've actually got here is 90 times e to the 0.0125. And you can see it ends up being $91.13. Okay, so again, you can think of this as the cost of financing this position for 3 months, which is the other option you have when you try to eliminate all your risk by buying the stock at a known price. You really only have 2 options. You can buy it through a forward contract, or else you can buy it now and pay the interest for the next 3 months. And so, in other words, either way, it's going to cost you $91.13. So what about, now this next case is a little unusual. What if you
Excuse me,
have
can we
an
go
asset-
back to can we go
Oh,
back to that
yes.
example quickly?
Yes.
So would we just basically have to take a quarter of 0.05 and multiply that
That's
by
right.
90? Okay.
Yep, that's right.
Okay, got it.
Yeah.
Okay, got it.
Do you have the phone right there if you want to practice
Yep.
with it? Okay, good. Okay, so that's the forward price, the 3-month forward price. When you talk about forward price, you have to specify the time frame because it can be literally anything. So this is a 3-month forward price with a spot price of 90. The 3-month forward price is, in this case, 91.13. Now, you're probably aware that bonds provide coupon payments to the owner in the United States, typically twice a year. Okay, so in other words, imagine you own a corporate bond issued by, let's say, Apple, and they have a coupon rate of 6%. That means twice a year you'll get a payment of 3% based on the original investment in that bond. Okay, so in other words, with a typical bond, you'll have a face value. And that face value is often $1,000. That's a standard practice in the United States. So in other words, when you buy the bond directly, brand new, it's $1,000. And then, so what happens is the investor receives interest payments known as coupons for historical reasons, semi-annually. That's usually normally in the United States until the bond matures, at which time the investor receives or is repaid the face value. Okay, so you buy it for $1,000. Let's say you get 20 years worth of interest payments, then you get your $1,000 back. So the bond has a specific coupon rate, which determines the size of the interest or coupon payments. All right, so let me just give you a quick example of that. So let's say you do buy an Apple bond. And let's say, and you can look up actual bond prices on the internet. There are websites that show you all the different bonds that are trading in the marketplace. So suppose a 20-year Apple bond has a face value of $1,000. The coupon rate, 6%. Now, this means that the owner will receive 3% coupons each year. Each will be worth $30. Why $30? Because 3% of 1,000. After 20 years, the investor will be repaid the $1,000 face value. So you're basically lending money to Apple when you do this. You're saying, I'm going to buy your bond. Here's my $1,000. You'll pay me interest for the next 20 years. And then at the end of that time, I'll get my money back. Now, how do you know that you're getting your money back? Well, you know that organizations like Standard & Poor's and Moody's are set up to provide bond ratings so that you know how safe a bond is before you buy it. Okay. None of you works for these companies, do you? No. Okay. So they're actually located, Standard & Poor's is located down by the South Street Seaport. I don't know where Moody's headquarters are, but anyway, so this way you don't buy a bond and say, oh God, I hope I get my money back. You'll have a rating available. You can see and for yourself how safe it really is. So this is an unusual structure because you're getting a very small number of payments throughout the lifetime of the bond. It's not like you're earning interest in a bank account, which carries on every single day. Instead, you're getting just 2 payments every year. Now, imagine yourself deciding to buy this Apple bond, but not until, let's say, next year. I want this bond, but I won't be able to pay for it until next year. So it can enter into a forward contract to buy the Apple bond for delivery in 1 year. The question is, how much will I be expected to pay for it? So that's case number 2. We're going to call this the known income asset. And you notice the difference is there's this one extra term in here that wasn't there before. And that's this I. So I is the present value of future cash flows to be received during the lifetime of this contract. So this only counts. So let's say this is a 1-year forward contract. Whatever coupons the bond will pay during that period are incorporated into I. Now, why is it being subtracted here? Because when you have the forward contract instead of the bond, you're not collecting those coupons. That only goes to the actual owners of the bonds. So that reduces the value of this position, and the price reflects that. Okay, so you have to reduce it to the fact that you're not getting the opportunity to earn these cash flows. Now, this one is kind of complicated, so let's run through this very slowly rather. Here's a treasury bond that matures in 15 months. The annual coupon is 5%. The next coupon comes due in 3 months. So that little timeline down here shows us what's going on. So that means that we're going to get a $50 coupon. Oh, by the way, I forgot to mention, this example assumes annual coupons just to keep it simple. All right, so in other words, in 3 months, we'll get a $50 coupon, and in 15 months, we'll get another one. And then at that time, the bond will mature, which means I also get my money back. So the two cash flows that I am going to receive in the next 15 months are $50 in 3 months, $1,050 in 15 months. Fine. Now, the market price of the bond at the moment is $1,020. So the interesting thing about bonds is the face value is only the appropriate price on the day that it is issued. After that, the market price will be different than the face value typically. Because, let me just quickly remind you how this works. This is actually one of the most fundamental principles in all of finance. When interest rates in the economy rise, bond prices fall, and vice versa. So if there's talk in the market about the Fed cutting rates, as a bondholder, you should be dancing, because that means the value of your portfolio is going to go up. Okay. Now, by the way, bondholders may sell their bonds prior to the maturity date, but they take the risk of selling them for a lower price than they paid for them. Okay, in other words, imagine me buying $1,000 bond, hoping to keep it for 20 years. 10 years down the road, I need the money to fix my roof or something. So I sell the bond, and it's only selling in the market for $950. That's $50 that I'm going to lose because I sold it at a time when interest rates were rising. So with bonds, you have two risks facing you. Number one, the risk that you don't actually get the payments if the issuer goes bankrupt. And number two, that the value declines if interest rates go up. So, you know, this is part of an area of finance called fixed income markets. It's a very interesting area of study. Very quantitative, by the way. In fact, if you ever saw that movie, The Big Short, does that ring a bell? The Big Short, about the housing crisis. In the beginning of the movie, they're saying, you know, it used to be that the bond markets are the most boring place to be. Now, all of a sudden, it's the best place to be because it's gotten so quantitative and so interesting and exciting. You know, because it used to be bonds were so dull, but now the derivatives that are available in the bonds make it a very exciting market. Although, of course, things can go bad like they did in The Big Short. But anyway, so what we're going to do is make some assumptions about the interest rates. Now, interest rates of different maturities will have typically different values. So we just saw with the treasury market, you notice how they're not all the same. Although in this case, they are just a little different. This is not normal, by the way, historically. Usually the gap between the very short-term treasuries and the long-term is much larger than this. This is kind of an unusual period in history. But if you want to see what conditions were like in the past, let's say you want to know what interest rates look like in, I don't know, 2018. Oh, it's here. Look how low they were. This is just a few years ago. Look how low interest rates were just 6 years ago. So market conditions can change dramatically over time, and they'll have a direct impact on interest rates. Okay. All right. Anyway, so the long and short of this is that during the next, let's see. Oh, okay. This is a 6-month forward contract. So in the next 6 months, today is 0, remember, the bond will pay 1 coupon. Okay. Just the one. So that's the only one that's relevant to the forward price of this bond. But because that coupon will not be paid for 3 months, the number I want to put into my formula is not $50, but what's called the present value of $50. Now, what this actually indicates is, this is a side note. The present value of a sum is the amount that must be invested today to be worth that amount in the future. So now let me just give you a quick example of that. So let's just keep it simple. Let's say that, suppose that an investor wants to have $10,000 in 1 year to make a down payment on a house. All right, fine. So let's just say that he can put the money in the bank today. Suppose that the investor can deposit money in a bank for 1 year that pays a 5% rate of interest on a continuously compounded basis. How much must he save today to reach his goal? Okay, so what you're going to do is this. You're going to take $10,000 and multiply it by e to the negative 0.05 times 1. Negative because the amount you start with today is less than the $10,000 you'll have next year. So if we go to our trusting calculators, let me just quickly run through that. Hold on. Oh, I just can't find it. What's going on here? All right, let me try that one more time. Okay, it's 9512.29. All right, so there's what this is saying is that if I put that much in the bank now, in 1 year, I'll have exactly $10,000. So this amount I see here, this is referred to as the present value of $10,000.
Can you just go over how you input that into the calculator, please?
Oh, yes. Okay. So, I'm looking at this thing and, now, by the way, I don't know if you're aware of it. They changed it a little bit within the last 6 months. So I'm still fumbling around here looking for certain things, but here's what you have to do. I think our best bet is to solve the e to the minus 0.05 first, and then multiply it by 10,000. I think it's just easier that way. So let's do that. So here's what I would do then. I'll type e. There's a little e button directly above pi, as a matter of fact. You see it there?
Yep.
I had a tough time finding it, let me tell you. Then you're going to type, this button is an exponentiation button, x to the y power. Okay, you see, and then that one is hiding directly under m plus.
Yep.
And then you're going to need to type, now this is where it gets really bizarre, 0.05, and then you're going to need this plus minus sign to flip it over to a negative number, and then hit the equal sign.
Okay, times 10,000. Got it.
Right, then multiply by 10,000.
Yeah. Huh. Okay.
And you'll have your result.
And because it's
Okay.
a full year, it's 1 versus if it were half a year, 6 months, it would be 0.5.
Correct. Or if it was 2 years, it would be a 2.
Right. Okay.
Okay. So anyway, so that means if he puts that much money in the bank now, he's guaranteed to have $10,000 in 1 year. So we call that the present value of the $10,000. So most of the time when we work with these formulas, we are actually calculating present values because the cash flows themselves will typically take place in the future. We may be buying something now, but often we don't receive any cash flows until down the road. So therefore, the value to us now is the present value, not the actual payment. So in finance, the purpose of present value is to equalize cash flows that are received at different point in time. So in other words, if let's say for some reason you worked on a job and somebody owed you money, if they offered you $10,000 in a year or 95, 12, 29 now, in principle, you should be indifferent between the two of them because it amounts to the same thing. Okay. Anyway, so with all that being said, the reason why we brought this up is because if you notice in this formula, this I is actually the present value of the coupon payment. Okay. So here it is right now. So actually, this would be some good practice. Why don't you see if you can reproduce that number now that you know the secrets of this calculator? See if you can come up with 49.6885 as the present value of $50, given it's a quarter of a year, 3 months, and the interest rate is 2.5%. And of course, the interest rates are always expressed as a decimal. So you've got negative, because it's a present value, 0.025 times 0.25, which represents 3 months. All right, so you do that correctly and then multiply it by 50, you'll end up with the number you're seeing right there. Is it not working? All right, here's what I'll tell you, just to be on the safe side, why don't you simplify it first? 0.025 times 0.25. So what you're actually doing here is 00625. I think that might speed it up a little. All right, so remember how it's E? I'll get rid of this part. x to the y 0.00625, and then hit that plus minus sign equals whatever that number is. It'll be slightly less than 1, and then you can multiply it by 50 to get your final result. All right, so let's
I'm
try.
sorry. Could you one more time explain
Yes.
the 2.5%
Oh, that's given in the problem.
in the problem? Okay.
Yeah, up here it
Oh
mentions that
yes.
this-
Okay, I missed that one. Okay.
Right.
Thank you.
Okay.
Got
So and then 3.25 means it's 3 months. So if you type that in, we're gonna do that right now with you. Oh, wait a minute. Oh God, you know what I just realized? There's an E to the X button in here that if you use the E to the X button, you can just replace all of this with the E. I just even noticed it up there now. Oops. Well, it's the same thing anyway you look at it. Either way. Uh-oh, what happened?
Got it.
Oh.
Yeah. So the key here is that you have to solve the time and the interest first to get that number, and then you have to.
Exactly. All right. And so I got 9937, et cetera. And then you multiply by 50. Yes. Okay. So it's just a hair under it. Now, it's not a very big difference because it's a small rate of interest. It's only 3 months and it's only $50. Okay. But that is what that coupon is worth to us now. So we take this value back to this formula. So don't forget, all we just did there was we calculated I. That's all we know right now. So now we have to do more work. Here it is. So you take the current market price of the bond, you subtract off the present value of the coupon. Now, because this contract is actually 6 month, the coupon occurred in 3 months, but this contract lasts for 6 months. So that means the T is actually a year. And it turns out that the rate of interest is different for 3 months and 6 months. So you have to use the 6-month rate of interest here, which is 3%. And like I showed you before, this is kind of normal. It's usually unusual that rates are the same for every maturity. So that means here you should replace this with e to the 0.015. Here, the value in parentheses is 1020 minus 49.6885. So on the left-hand side, okay, I obviously made a typo. Hold on 1 second. Yeah, this is not, I don't use this one on a regular basis. But the beauty of it is that it's a very powerful calculator and everybody has it in their pocket. So you're multiplying this number by e to the 0.015, whatever that is, to get this final result over here. Is it working? So e to the 0.015 should be approximately, let me just double check that at mine. 1.015 on one, let's say. How did that go? Did you get the same number? By the way, if this shows up on an assignment, which it will obviously, you can feel free to do this in Excel if you're strong in Excel. I don't know about you. At this point in time, I use Excel for everything. Excellent. So that now is the 6-month forward price. If I want to buy this bond for delivery in 6 months, I only have to pay 984.9759 because I'm giving up the opportunity to earn that coupon. Otherwise, it would be worth more than that. It would be worth the current spot price. Now, this is the one that I really wanted you to, this is really the most interesting one. So we just saw the case of an asset that provides occasional cash flows. What about other assets? Now, here's the logic behind what we're about to do is this. If an investor holds a foreign currency, he or she can earn foreign rate of interest by holding the funds in what's called a euro currency account. So let's say you are in the New York City and you own British bonds, sorry, British pounds. What am I saying? So for example, an American can hold British pounds in what's called a euro sterling account. And this would require you to be doing business with a major investment, or not investment, but a major commercial bank, like let's say Chase. And so what this is, the euro currency markets, mainly they're headquartered in London, but it means that you are holding funds in a bank account, which is where the currency is different from the home country. In other words, if I'm holding dollars in a British bank account in the UK, that means I have what's called a euro dollar deposit. And I'm not earning the British pound rate of interest, I'm earning the US dollar rate of interest. And so similarly, I as an American can hold pounds in an account where I'm earning the British pound rate of interest in a euro sterling account. It's called sterling, by the way, because whether you knew it or not, the actual name of that currency is the pound sterling. So that means that as the owner of the British pound, I'm earning the British pound rate of interest. Now, in practice, bank accounts, including euro currency accounts, pay interest or pay interest that is compounded daily. Now, so what does this have to do with anything? Continuous compounding only pays slightly higher rate, provides a slightly higher return. Than daily compounding. So what that means is with our forward price of a currency is determined by the spot exchange rate and the interest rates, actually the risk-free rates of interest in the two countries. For example, the forward exchange rate between the dollar and the pound is determined by, I need another slide here, the respective, rates paid on euro dollar and euro sterling accounts. Now, there's a bit of, fudging going on here because these accounts are technically not risk-free, but they're awfully close. And the compounding is not continuous, it's typically daily. So, but for all practical purposes, we can then calculate the forward price of any currency with this asset, this model right here. Okay, so how would that work for the pound and the dollar? So that means the forward exchange rate between the dollar and the pound this is the spot exchange rate. This would be this is the domestic currency, the euro dollar rate. Q would be the euro sterling rate. And of course, T is the maturity of the contract. So it could be, for example, 6 months. And that's how it's calculated. So there, I think there's an example right here. Oh yeah, here we are. Very good. So let's just say that the exchange rate is $1.80 per pound. Now, of course, it's not at this point in time, but let's say it is. The US risk-free rate, meaning the euro dollar rate, is 3%. UK rate, or the euro sterling rate, is 5. And we're looking at the 6-month. We want to calculate the 6-month forward exchange rate. Now, based on the variables in that model, S, the spot exchange rate, is $1.80 per pound. R, the domestic rate of interest, is 3%. Q, the foreign rate of interest, is 5%. So you plug those in, and you can see where all the numbers go. And so this is R, this is Q. So in other words, UK rates are 2 percentage points higher than in the US. The spread between them is 2%, but this is only for 6 months. So what you're actually doing here is taking 180, the spot exchange rate, and multiplying it by e to the negative 0.01. All right, so you go back to your calculator and calculate the value of e raised to the negative 0.01 power, and then multiply by $1.80. You should get 1,782 per pound. Wow. So now this means that if I want to buy pounds now, I pay $1.80. If I want to buy them in 6 months, I'll pay 1,782. So this is the so-called 6-month forward exchange rate. This is the spot exchange rate. Now, by the way, if you notice, this forward price in this case is lower than the spot price. That's because UK rates are higher than in the US. If it was the other way around, then you have to pay more for pounds in the future. Now, it turns out that in the field of international finance, this relationship has a very specific name. It's referred to as interest rate parity. The forward versus spot exchange rate for any two currencies based on their respective interest rates, we call it interest rate parity. Now, just in case, I've got all 3 of these listed here, so you can look at them at a glance and make sure you don't forget which is which. All right. So now we're ready for our intense look at futures contracts. So we already have a sense of what's coming up here. What are the differences between, futures and the forwards, and why would you choose one over the other? By the way, with the futures contracts, because of the marking to market procedure, you can't actually define a specific formula for futures prices like you can with forward prices. The best we can do is designate a range of possible values. Okay, so it might be a little disappointing, but you'll see that they can't deviate too much from forward prices. So the futures contracts, as we recall from last time, these are negotiated. Forward contracts are traded in the over-the-counter market, meaning directly between counterparties. Futures contracts are traded on exchanges like the CME. All right, our old friend, the CME. And let's see if we can find a contract on the British pound. Let's see. Here it is. All right. Now, of course, March is coming up very soon. If you bought a contract for delivery in March, the current futures price is $1.2599 per pound. It went down a little bit since yesterday. The opening price this morning was 125.94. It got as high as 126.05. It fell as low as 125.93. And then about 28.45 contracts were traded during the day. Okay. So this is the settlement price. At the end of the day, the committees at the CME will get together and figure out the exact value of this currency, and that will determine what is the balance in your margin account. Remember, we discussed this last time. A margin account is a deposit of funds with the exchange. It guarantees the performance of your contract. If the value goes up, you get money put into your account by the exchange. If it goes down, then it comes out, and at some point you may have to provide more funds to keep your account active. So some of the terms and conditions, by the way, this tells me that there is available on this contract an option to buy it or sell it. Okay, so anyway, let's see. There's others. There's plenty of others. They have all the major currency pairs here. What else do we know that's different? Oh, now since the forward contract is directly negotiated between two counterparties, there's always a chance of default, or one side doesn't live up to their obligation. And so luckily within the exchanges, they guarantee their performance of the contracts. There's no credit risk. Futures contracts can be easily offset or unwound by taking the opposite position. So if I entered here into this contract to buy pounds in March, and I decide I don't want to do this, I would just enter into a short position in the same contract, and they would exactly offset each other. That's easy with futures. It's not going to happen with forwards. With the forward, you're absolutely obligated to go ahead and do whatever you agreed to do. So that means that usually hedgers will choose between the forward and the futures contract. This is one of the main reasons for choosing one over the other. So in other words, hedgers who do not need to actually buy or sell an asset are more likely to use a futures contract, since it is easy to unwind. Okay, so in other words, let's say you're just trying to collect a profit, or minimize your losses, whatever the case may be. If you don't really mean to take the contract to the currency, let's say, you're probably better off using a futures contract, because there's never any obligation to buy or sell, because you can unwind your position. Okay. So that is one of the deciding factors when you decide whether to hedge with a forward or a futures contract. Do you really need to buy or sell this asset? Now, we also know that about this marking to market procedure where you put money into an account with an exchange, and this is called marking to market, and you can find out. Let's see if we can look it up for this contract. British pound futures margin rate. So you start up this position. $2,000. Now, keep in mind, this contract is written on 62,500 pounds. So if they're selling at $1.30, let's say, the actual delivery price of those pounds is going to be 62,500 times one, let's say 130, about, oh, wait a minute. About $81,250. And yet the margin only is required $2,000. Okay. So it's not a huge amount of money. It's just collateral. It's just there just in case you start losing a lot of money and you can't cover your losses. They want to make sure that they don't get left holding the bag and having to cover your losses. So that account or that amount is meant to represent what they believe is the most that you could realistically lose in a single trading day. Okay, so notice from experience, they don't believe this account will fluctuate by more than $2,000, so they can feel free to let you have that little amount in your margin account. Now, I believe, oh, look what I did. I went ahead and found all these terms and conditions. And again, I mentioned before, 62,500. That's a lot of pounds. That might be more than you want. And if that's the case, you should really use a forward contract because with a forward contract, you can have whatever you want. The minimum change in your value won't change unless the exchange rate moves by 0.0001 cents per pound. In other words, the value of the contract has to move by at least $6.25 before they record it. And then the deliveries are typically available every 3 months. Oh, no, it's the next 3 months, and then after that, it's all quarterly, March, June, September, and December. So, let's see, I think I have an example here. There we go. So let's say that you enter into one of these contracts, and at the moment, the futures price is $1.26 per pound. Fine. The initial margin that you have to put up is $16.50. Maintenance is $1,000, which means if your balance falls below $1,000, you've got to put more money into your account. Now, every time the exchange rate changes by a penny, that changes the value of your position by $625. If the balance goes up, you can take the surplus above $16.50. If it goes down, you may have to put more money into your account. So let's take a look at this case. Now, so here we have the price. Day zero is today. Here's your margin balance. You put that money in yourself. The first day we lose money. And the balance drops to 1331.25. But now remember, the maintenance margin is 1,000, so that we don't have to put any more money back in unless our balance falls below 1,000. Then it goes up. Now here we could actually withdraw everything above 1650 if we choose to do so. Let's say we don't though. We leave the money in, and the next day we lose money. We're down to 1231.25. Then on day 4, disaster strikes. The balance in our account is less than $1,000. What we have to do is put enough money to not only bring it back to 1,000, but the original balance of 1650, which means we better put up 706.25, or they will close out our account. Then the price goes back up and suddenly we're at 22.9375. So between the amounts we deposited, that's about 2306.25. So our balance is slightly down from where we started. Right here. Okay, but we can, if we want, withdraw anything above 1650. So it just goes on and on and on until the final trading day. And then either take delivery of the asset or else you simply unwind your position. So at this point, we've lost a total of 318.75. All right, so that would be a typical example of marking to market. Now, what's coming up next is this discussion about a very important concept that we'll see over and over again with our discussion about futures, and that's called arbitrage. All right, let me just briefly introduce this topic before we carry on with this. Arbitrage refers to a process by which investors can earn risk-free profits with borrowed money by buying a relatively underpriced asset, selling a relatively overpriced asset. So let me give you a quick example of this. So yeah, a lot of the logic behind what we see in the derivatives markets is based on this notion of arbitrage. So it's an awfully important concept. You don't see this in most markets. This is the one where it becomes extremely important. And so just as a quick example, suppose that in the US, gold sells for, let's say, $2,000 an ounce. The spot exchange rate between the dollar and the pound is, let's say, 1.30 per pound. In London, gold sells for, or at least we can find a dealer in London who's offering to sell gold for, I better check this with my calculator. £1,600. All right, so you're looking at that and saying, well, so what? Okay, well, £1,600 is currently worth multiply those out. Of $2,080. So guess what? This means that, and of course, this is assuming that, I mean, because this is gold is the same in both countries. It's not like there's a quality difference or something. Gold is relatively overpriced in London. Gold is relatively underpriced in, let's say, New York. So these are dealers in the two. Let's change this to in New York. Gold sells for. So these are dealers. These are metals dealers, and one of them is quoting a price of $2,000 an ounce. And in London, we find another dealer who's quoting £1,600. Now you're a sharp observer of these markets. You watch these markets every day. You're a trader, let's say, with one of the big investment banks, and so you'll notice this and say, "Listen, a trader can earn risk-free arbitrage profits by doing what? Buying gold in New York, selling in London. Actually, I should have put in here for 2000 and selling in London for 2080. Wow. Well, that's nice. You have the opportunity to buy it cheaply in New York and resell it in London for 2080. So in other words, this earns $80 per ounce. And I'll put in parentheses here, net of transactions costs. Because of course you have to actually pay to have the gold shipped to London. But let's say as long as transactions costs are less than $80 an ounce, the investor will earn profits. And the money itself could be borrowed. So the money used to buy the gold, New York can be borrowed and repaid almost immediately. So for all practical purposes, it's not costing you any money to borrow this money. It's like a matter of seconds that this happens. Now, wouldn't it be wonderful if this could happen and you can sit there and look for these opportunities to make money? Well, as you can probably guess, markets are insanely efficient. In practice, markets are highly efficient. And this is unlikely to arise. Now, having said that, though, but I mean, well, by the way, let's just take a step back. Imagine this is not 2025, but 1975. At that point in time, where are these prices coming from? Most likely you're picking up the phone and calling other dealers to find out who's paying what for gold. And you can imagine in those days, this type of thing could occasionally happen. In fact, there used to be on Wall Street jobs for people who are called arbitrageurs. This is what they would do all day. Now, at this point in time, today, markets are extremely efficient, but they're not perfect. So what happens is you find these hedge funds that are set up. There are hedge funds known as statistical arbitrage. Well, among others, there's plenty of them, but that specialize in finding these opportunities and profiting. But here's the big but. This requires it's gotten to the point where it's too fast for human beings. Okay. And by the way, let me just run back here for a second. Even back in the 50s or 60s, whatever, as this process continues, you can see that what's going to happen is if traders are buying gold in New York, the price will go up. And fall in London until they're equalized. Okay, because if you're dumping gold in one market and you're buying up like crazy in the other, the prices have to adjust, of course. And so this kind of thing will only last for a short period of time if it arises in the first place. Okay, so I just want to make sure that's clear. You can't just say, well, this will last forever, right? No, it doesn't work that way. So, but as far as the statistical arbitrage funds go, what has to happen is extremely high-powered computers are continuously searching market data for these opportunities and are programmed to buy or sell when opportunities arise. So in other words, human beings are not even doing the transactions. The computer has been programmed to look for them. And if it spots a momentary discrepancy, it jumps in and buys or sells. And hopefully that's enough to make money because it disappears so quickly. Okay. So yes, it's still possible, but obviously it's a lot more difficult than it used to be. So, but at the same time, though, the fact that arbitrage can take place ensures that the price of gold in New York and London will remain equal after taking into account transactions costs. So there was the fact that this can be done means that you're not really ever going to expect to see the prices be different from each other. So markets are crazy efficient because all the information that's out there, computers are showing us everything that's going on in the markets. And so the fact that it can happen is what ensures that it doesn't happen, actually. So anyway, so what the relevance of this is that the formulas used to compute forward prices are known as no arbitrage odds. Since because if market prices deviate from these models, then arbitrage opportunities will rise. As they are exploited, the forward price models will be reestablished. In other words, if the market prices are different than what you're seeing in these models, very quickly they'll be corrected by arbitrage activity. So those models are referred to often as no arbitrage models because it means that if there's a discrepancy, it'll be corrected by arbitrage activities. So this is something you see quite a bit of in the derivatives markets. You don't often see it in other markets. This is something that you see on a regular basis. So when we start looking at options, for example, you'll see that a lot of the relationships between them are coming down to the idea that if these relationships are not being observed in the market, it's because they will be corrected by arbitrage activity. Okay, so anyway, what was all this all about? The same thing's happening here between spot and futures prices. So we already know how spot and forward prices are tied together. What's happening here is that over time, you've got, let's say, here's time, here's dollars. Here's the spot price of an asset, and let's say here's the forward price. I'm sorry, futures price. So they can wander around, and they don't have to match. I mean, the relationship between them is not as precise as it is with spot and forward prices because of the market process. But we do know that at some point when on the maturity date of this contract, they have to be equal to each other. That's the day on which the contract matures or expires. And if you haven't done anything to offset your position, you're going to take delivery of the asset or you're going to make delivery. So now there's a discussion here about how and why this is happening. And the way normally you explain arbitrage is to say, well, what would happen if this is not true? And there's only two other things that can be true. F is less than S, F is greater than S. So let's say that for some bizarre reason, we end up with something like this. Here's S, and here's F. Well, here's what you could do. Now, remember, the point of arbitrage is to buy something that's too cheap and sell something that's too expensive. So we're going to enter into a long futures contract. In other words, we're going to buy F. We're going to take delivery at that price and then deliver it for ST, which is the spot price. And we'll earn this profit. Wow. If it's the other way around, then what you're going to do is buy the spot asset, enter into a short futures contract to deliver the asset for FT dollars. And then when you do deliver it, you'll collect FT, which is greater than ST. So you'll make a profit. Okay. So that means they better equal each other. Otherwise, there'll be arbitrage opportunities which will force them to equal each other. Okay. Now, this is very much a lot to take in the first time you start thinking about arbitrage. We will have many opportunities to think about arbitrage, but the logic here is that you're buying whichever is too cheap and you're selling the one that's too expensive, and you're putting the difference in your pocket without taking on any risk. Okay, if there's risk involved, it is not an arbitrage. It's a smart investment, but it's not an arbitrage. The arbitrage must be completely risk-free. All right, that's the bottom line. All right.
What's the time frame for that? So if you were to, let's say, buy a spot price and then you wanted to sell it for the future price, what's the time frame? Can you just do it instantaneously?
Immediately. No, the computers are going to do this. It's going
Okay.
to have to happen immediately. Because otherwise time could, let's say it takes 10 minutes
Right.
to make a transaction, all of a sudden the relationships are different.
Right,
the
right.
computer, for all practical purposes, these are simultaneous. Or as simultaneously as we can get. Okay. All right. Well, that's really kind of our first look at arbitrage. Now, there's a theoretical discussion here about whether futures and forward prices need to be, how they're related to each other. Let's see, I think I'll tell you what, I think maybe we can hang on to that. I'd rather jump ahead and look at these hedging strategies. We'll come back to this later on. This involves a lot of statistics. Maybe we can discuss it at another point. This is what I really wanted to get to more. How do you hedge with these contracts? Okay, now forward contracts are a simple matter because you can choose any asset you want for delivery anytime. It's easy. It's not so easy with futures contracts because they're not all that flexible. There's only a handful of different contracts available for any asset. And if they don't exactly match your needs, then you have to make some adjustments. Okay, so you can see here the list of reasons why this all becomes necessary, because first, we obviously know that futures contracts cannot be customized. There's a fixed number of contracts available, and they all require marking to market. So that makes hedging a lot more challenging. In particular, the fact that not every asset out there has a futures contract available on it. In fact, like here's one of my favorite examples. What if an import company in New York City, and I buy a lot of my merchandise in Iceland. Okay, my store carries Icelandic products, and now of course I'm exposed to the risk that the currency, the Icelandic krona, will fluctuate against the dollar. So you might say, well, what's the problem? Buy a futures contract in the krona. Well, they don't have one. It doesn't exist. Iceland's economy is just too small for that. So what I can either do is number one, go to the forward market and get a contract on the krona, or now this is where it gets interesting. What if instead I do this? What if I can instead enter into a futures contract on the euro? And you're probably saying, why the euro? We're not doing business in Europe. We're doing business in Iceland. Well, how does that help me? Well, this comes down to this magic word, correlation. Now, I'm guessing that everybody in their travels has experienced this word correlation, a measure of how closely two variables are related to each other. So let's say, for example, it would be clear that, for example, a corporation's sales and profits are highly correlated with each other. Because obviously you can't have high profits unless you have high sales, right? Or at least it's not likely. So the correlation measure itself is usually indicated with this special Greek letter. Oh, let me do this. This is the Greek letter rho. That means this is the correlation between two variables. And you might remember from your travels that this number is always going to be between positive and negative 1. Okay, so the way we interpret it is that a high, let's say the rho between two variables is very high and it's positive. You get something like that. What if, on the other hand, there's a positive relationship, but it's not all that strong? Let's say you might end up with a 0.3 for your correlation. Let's say you have a negative relationship, but it's a very strong one. And then same thing down here. So in the upper left-hand corner, we have a strong positive relationship. The upper right-hand corner, it's a weak positive relationship. Bottom left-hand corner, it's strong negative relationship. Bottom right-hand corner, weak negative relationship. And then one possibility, which is very important, is the one where the two variables are essentially unrelated to each other. And then in that case, rho would be 0, and these variables are independent or unrelated to each other. So between all of these cases, which one do you think would describe the relationship between the value of the euro and the Icelandic krona? Now, here's a hint. Who does Iceland do most of its trade with? The European, the euro, as they're called, the Eurozone members, the ones who use the euro. So it stands to reason that the economy of Iceland is heavily related to the economy of the Eurozone countries. So the correlation would be very close to 1. So why does that matter? So therefore, a futures contract on the euro will help reduce or eliminate the risk of a fluctuating Icelandic. Does that make sense? So in other words, because they're so closely related to each other, Iceland and the Eurozone members, if I hedge the euro instead of the Icelandic krona, I'll end up with roughly the same thing because the two are so closely related to each other. So if euro is going up 10%, the Icelandic krona might also go up 10% and vice versa because of the high correlation between them. So this is one option we have if we really want to use a futures contract on an asset that doesn't, where there isn't a contract. I can choose another contract that is closely related or correlated with the one I need to hedge. So this is one way to work around the problem that these contracts are not customizable. Okay. Wow. Now that was interesting. So when was the last time you thought about correlation? It's been a while. Yes, it has. Okay. But it was there when you needed it, right? You thought to yourself, let me think of ways back. Let me go back to the old days when I was in statistics class. That's right. I remember this good stuff. It never deserts you, does it? Knowledge, I mean. All right. Anyway, so that's one good thing about these contracts. Even if they don't have the one we need, we should be able to find one that's closely related to it. Like, well, here would be another quick example. What if there does exist a contract on copper? What if my business is nickel, let's say? If they're closely related to each other, I can usually hedge my nickel risk with copper instead. All right, now what we just described is called cross hedging. So let's say instead it's the Swedish krona, same thing. They do most of their business with the Eurozone members. So it stands to reason that the Swedish krona would be highly correlated with the European euro, and therefore I could use a euro contract to hedge the risk of doing business in Sweden. Okay. All right. Now, one thing we do have to consider is, let's say, how many contracts should be used to hedge a given exposure? Now, why does this matter? For example, remember the British pound futures contract is written on 62,500 pounds. Suppose an investor wants to hedge the exposure to let's say 220,000 pounds. How many contracts should he or she use? Now, with the forward contract, you don't have to even think about it. You just get into a contract on 220,000 pounds. It's easy. Here, you don't have that option. You've got to pick 62,500 at a time. So what we can do is we can describe what's called an optimal hedge ratio, whose purpose is to tell us the precise number of futures contracts we should use to hedge a given exposure. Now, this one again involves a certain amount of statistics, but we'll discuss it as we go along. Okay. Now, having said all that, wow, the time really got away from us tonight. Why don't we knock it off for a bit, have our break? We'll come back, let's say 8:15, and then we'll discuss this optimal hedge ratio and some of the related hedging strategies. So, yeah, actually,
contracts that are the same amount going opposite directions, because then it just cancels each other out. No.
Well, that's if you're unwinding a contract, but if your exposure is different than the amount in the contract, like I said here, This contract, the only one they have is worth 62,500 pounds. If that's not the amount of money you want to hedge, then you've got to figure out how many contracts you should use. Maybe you should use more, maybe you should use less. So it turns out there are statistical tools we can use to figure out how many contracts we should buy or sell to properly hedge our risk and minimize the amount of risk that's left over. Okay, so this complicates everything. The fact that we can't customize the number of pounds that we can hedge with a futures contract. So anyway, let's knock it off for a bit. Let's have our break. When we get back, we'll go into this and we'll see what this is all about. Okay. So in the meantime, I'm going to pause the sharing because otherwise the recording will have a lot of blank time in it. We don't want that. So let's do that. Ah, all right, so we'll just quickly run through this now. There's two of the standard approaches to hedging with futures contracts can be summarized as the basic approach and the minimum variance approach. One of them is a very simple one. The other one is based on statistics. So the basic approach is basically, to the extent that's possible, to hedge your position with a futures contract or a futures position of more or less the same size. Okay, in other words, if you are trying to hedge a position of, let's say, 625,000 British pounds. Now, this is, of course, a very simple example. Then you can hedge that with 10 futures contracts. Because each one is worth 62,500. So yeah, of course, that would be ideal, but not necessarily. It turns out that that's not necessarily the best strategy, but with a forward contract, you can literally cover any position you want. So this is one of the drawbacks to a futures contract hedge. But the problem then comes into when you have, let's say, a relatively small position. Like, what if instead you have suppose that a hedger has exposure to, say, 90,000 British pounds. Well, if you divide that, see, there's the rub. It's going to be slightly more than one uh, contract. 90,000 divided by 62,500. Yeah. Oh, wait a minute. What happened? Hold on. It's 1.44. So then you would have to choose between one or two. Which is kind of awkward because in the first case, you're not hedging all of your exposure. In the second case, you're hedging more than your exposure. So, neither one of them is ideal, but the one you would end up choosing would, I guess, depend on how much of an impact each change in the exchange rate would have on your position. And the goal there would be to simply figure out which one has the minimum impact, which would mean you're exposed to the least amount of risk. And if this still doesn't work for you, then it might be time to try a forward contract. All right. Anyway, now this is the one I was referring to earlier. This is one that's based on statistics. Now, this ratio is based on, you can see the correlation coefficient there, but it also includes standard deviations, which I'll just briefly remind you that if you remember from your statistics days, and we'll see more of this later on in the course as we go along. We'll run into other situations that require some statistical concepts. The standard deviation is a measure of risk or uncertainty for financial assets. Now, it can be used for many other disciplines too, but when we are dealing specifically with finance, we often use it to represent how much risk there is associated with owning, let's say, a stock in your portfolio, because it basically measures how much the value of that asset fluctuates over time. So obviously the more the asset's value changes, the riskier it is to the investor, that is, and the higher is its standard deviation. Okay, so we're not going to get into the details tonight about how to calculate it. We'll get to that later on. But just the word standard deviation, when you see it, just be aware it's a measure of risk. And so the one thing I do want to point out, in case you've heard of this before, standard deviation of the returns to an asset is often referred to as the volatility of the asset. So if you hear that word volatility kicking around, it is often measured with this measure standard deviation. So what's happening here with this measure, this ratio, H star, the star means this is the quote optimal ratio because it minimizes the risk of the position, is the ratio of, and now imagine, for example, you're hedging the exposure to the Swedish kroner using a euro futures contract. So what this ratio is telling us is that in the numerator, you have the standard deviation of risk of the kroner itself. And in the denominator, we have the risk of the futures contract or futures price itself. And then we multiply that by the correlation between the dollar and the kroner. So that number, whatever it is, will tell us how many contracts we need to buy relative to the size of our exposure. So let's say, here we go. So imagine that an importer is buying 100 million Swedish kroner in 3 months, sorry, and then hedges this position with a short futures contract on 125,000 euros. Oh, I threw that up there in the top in case you're wondering, like, what would I buy from Sweden? How about lingonberry jam? Okay, that's one of Sweden's best products. And so I'm an importer. I sell that in my store, and I'm going to need 100,000 kroner in 3 months to buy more jam for my stores. Now, let's assume the two standard deviations are the dollar kroner exchange rate has a standard deviation of 0.20. The futures price of this contract, the euro contract, is 0.15, and the correlation between the two is 0.82. So we plug these into our formula, and we end up with a ratio of 1.093. Now, since our exposure is 100 million kroner, we multiply that by this ratio of 1.093, and we end up with a position of $109,300,000. Now, again, even here we have a bit of an issue. Let's say that each contract is for 62,500 kroner. I'm sorry, euros. Then if you divide this by 62,500, that ratio is going to be not an even amount, that's for sure. Uh, 1748.8 contracts. Which means in a case like that, I'm sure you could feel free to round it to 1749, but you get the idea. You're never going to get it just right with a futures contract. It's not likely, let's put it that way. So you will have to decide whether you're going to take slightly more contracts, slightly less, but this is one way you could figure out the optimal number of contracts that you should buy or sell. Okay. So, now here's another example. What if instead the contract size is 125,000? Well, in that case, it turned out to be about 874. So in other words, the 1.093 is the ratio of how much of the futures position you should have relative to the size of your spot position. And then we have to divide that by the size of a contract. All right, so just a quick summary of all this good stuff. The number of futures contracts needed to hedge an exposure can be determined with the basic approach or the minimum variance hedge ratio. The basic approach is simpler, but it's less likely to be accurate. If there is not a futures contract available and the asset being hedged, the best choice is to find one that is highly correlated with the asset that you're trying to hedge, like using a Euro futures contract to hedge exposure to the Swedish kroner or possibly the Icelandic kroner. Now, here's another issue too. What about the maturity date? What if your exposure takes place on June 1st and the only available contracts expire on March, let's say 30 or July 30? What do you do now? Well, usually it's recommended that you choose the later one because if you don't, you'll have this gap where you're completely exposed to risk and you may have to start up a new contract whose value is unknown to us today. So if we have to choose between these two dates, normally it's recommended that you choose the later one because at least you'll know what to expect. If I have to start a new contract here, I won't know in advance how much I have to pay for it. All right, and then, right, so here's an example. If we need to buy Swedish kroner in August, the nearest contracts are in June and September. Ideally, we'll use September. And also, by the way, if you let your contract expire in June, you may have to actually end up taking delivery of the kroner. So we don't want that either for the most part. So having a later date also reduces the risk that you'll actually have to take or make delivery of the underlying asset. So, oh, that seems to be all of it. Let's just see what's coming next week. Oh, I see what's going to happen. So this coming week, we're going to have swaps. Now, this one will be very Excel intensive. What we're going to essentially do is remind ourselves how swaps work, but even more importantly, we're going to figure out the pricing of these swaps. Okay, so that's fairly complicated. That's why we're going to do it in Excel. There's a template in here somewhere that we can use to work on our examples. And so the thing about swaps is it's a kind of situation where you're entering into it with a counterparty, and every dollar you earn is going to come at the expense of the counterparty. So every swap has a price, positive for one side, negative for the other. And that's what we're trying to figure out with our Excel spreadsheets. We're also going to try to figure out how this helps us hedge our risk using either interest rate swaps or possibly currency swaps. And so it should be pretty interesting, but a lot of Excel to get the results we need. And then the following week, we can dive properly into options. And that's going to be where most of our time is spent because of their complexity. But at the same time, though, they're easily the most interesting of all the derivatives. Well, all right, I guess we're kind of done with this content. Sadly enough, I guess we'll have to stop early tonight. Does anyone have a problem with that? Good. All right. We went faster than I thought, that's for sure. So, all right. So I'm going to post this onto Brightspace, and hopefully this time all the notes will be there. And the video, I'll put it in both my YouTube account as well as Brightspace, so you can find it in either one. Okay. So I think there is an assignment this week. Let me just go take a quick look at it. So remember, both of them are due this week because of that screw up with the formula. And this time, let's see what it's in here. Yeah, these are all the same things we did tonight. Good, perfect. This time there's no problem. You definitely know what you need to know to get this one done too. Okay. Beautiful. All right. So if you have no questions, I guess we'll meet up again next Thursday. All right. So good night, everyone.